Hi there, this is Victor Alui. I'm the head of investment strategy at Sankore Global Investments, and this is your weekly financial market update. We start off in the US where the market maintained its strong performance as it closed Friday higher. Both the S&P and the Dow surged to new records, with the S&P adding 0.4% on Friday, while the Dow was up about 9 basis points. The Nasdaq added 0.63% on Friday. The two major averages essentially clinched their sixth straight positive week, marking the longest string of weekly advances this year. So for the week, the Dow was up 0.96%, the S&P was up 0.85%, while the Nasdaq added 0.8% for the week. The market has largely been supported by better than expected earnings. If you look at the total number of earnings that we've seen so far, about 70 of the S&P companies have reported so far. About 75% of them have beaten expectations, even though these expectations have been revised, lower. I mean, Q3 earnings have been revised downwards by about 3.6%. This is higher than the 3.3% average downward revision that we've seen over the last 10 years. And it's also much higher than the 0.5% downward revision that we saw for Q2 estimates. Now, if you look at historical trend, particularly around elections, you would see typically increased volatility leading up to the election, but that's not what we're seeing playing out this time around. And it looks like stocks are essentially going to rally into the election with the likelihood that we could see some volatility in the immediate aftermath of the election. But clearly, there is quite some exuberance in the market, and that has been largely supported by the better than expected earnings that we have seen thus far. And then the elections not necessarily having the sort of impact that we would typically see, at least from a historical perspective. For the remainder of this week, really going into this week, earnings will continue. We'll be looking to see earnings from Tesla, for instance, which will be a major one. Also, a slew of economic data will be coming through. PMI data, both services and manufacturing, will be coming through this week. Initial jobless claims as well. And then quite some Fed speak in the course of the week. So we expect all of these to really shape market sentiments, with earnings being really on the front burner. Over in Europe, the ECB cut its benchmark rates, for the third time by 25 basis points, bringing the rates to 3.25%. This move was largely expected, and I think had been priced in, by the market, really, particularly after policymakers started to flag, reduced inflation on the heels of the last inflation number that we had seen, and also the risk of a weakening growth outlook. In its post-meeting statement, the ECB Governing Council highlighted the fact that, the disinflation process was well on track. Like I highlighted earlier, headline inflation had slipped to 1.8% in September, below the ECB's target of 2%. Also, the ECB trimmed its Eurozone growth forecast for 2024. That trimming came out last month, and this was basically on the back of weaker domestic demand. It's now projecting a 0.8% growth across the Eurozone from a 0.9% growth that it had projected earlier on. I mean, some of its biggest economies continue to face major challenges, including manufacturing weakness in China. There's also a huge, fiscal consolidation project that's looming in France. And then if you look at a lot of the sentiment indicators, they really remain weak. So the ECB is essentially justifying this move on the back of, a significantly improved inflation outlook. However, growth is seeming to sort of falter. Over in the UK, inflation also fell 1.7%, which was below that, 2% BOE target, for the first time in 3 years. Again, this was lower than the 1.9% that we had seen, or that the market had expected, and also the 2.2% that we had seen in August. Core inflation came in at 3.2%, down from 3.6%, and also below the 3.4% that the market had expected. Price pressures in the service sector, which accounts for really a dominant portion of the UK economy, eased. This had, posed some concerns to the BOE, but we saw that ease to about 4.9% from 5.6% that we had seen in August. And this was its lowest point in about 2.5 years. So from a monetary policy perspective, the market is now pricing in a 92% probability that we'll see a 25 basis points cut at the November meeting for the BOE, with a follow-up cut in December. So essentially, 2 more cuts would certainly take the BOE benchmark rate to about 4.5% by the end of the year, because the bank started cutting in August and then paused in September. On the back of this inflation number and what the market is really expecting, we've seen the pound fall. We've also seen UK bonds, which are referred to as gilts. We've seen yields there also drop. Gilts on the 2-year gilts drop about 9 basis points, while gilts on the 10-year yields on the 10-year gilts dropped by about 7 basis points. Over in China, Q3 GDP came out with a growth number of 4.6%, which was better than the 4.5% that the market had expected, but was also kind of weaker than the 4.7% that we had seen in the second quarter of 2024. Nevertheless, we saw some macro data that looked sort of encouraging. Retail sales and industrial production came in better than expected. Retail sales grew 3.1% year on year, better than the 2.5% that the market had expected, and also the 2.1% that we had seen in August. Industrial production expanded by 5.4% year on year, better than the 4.5% that analysts had expected. We also saw fixed asset investment grow 3.4% year on year, while urban unemployment came in at 5.1%. Now, all of this data is basically coming on the heels of a flurry of stimulus measures that were aimed really at, reflecting its flagging economy. We saw quite, the push in terms of monetary policy a couple of weeks ago, which was just aimed at reflecting the economy. Early this morning, the PBOC lowered its benchmark rate by 25 basis points. So basically, this essentially reduced the 1-year loan prime rate to 3.1% and the 5-year loan prime rate to 3.6%. Now, the 1-year loan prime rate typically influences, the rates for loans for corporates and also for households, while the 5-year loan prime rate essentially serves as a benchmark for mortgage rates. Locally here in Nigeria, sentiment in the T-bills market last week was largely driven by tight liquidity. System, closed or was around about 1.4 trillion short during the week. So obviously, this saw participants sell their positions to sort of raise liquidity. And that bearish sentiment essentially intensified when we got that higher inflation print in the course of the week. The sentiment in the bond market was largely the same. Participants were essentially staying cautious in anticipation of the outcome of the bond auction that is holding today. The DMO is basically offering about 180 billion for the 2029 and 2031 bond maturities. The market is really expecting that bonds would, close higher, particularly on the back of the higher inflation prints that we saw last week, and also the sort of seeming commitment by the Apex Bank at really targeting inflation. The market had been sideways for the better part of last week. So just on the back of this, the market is really expecting that yields are going to close higher. But I think that the outcome of this auction will certainly be crucial in determining how this fixed income market behaves, going forward. Whether the DMO decides to take on more, whether it goes aggressive, markets is really looking out to see the outcome of this auction. And like I said, it will really, really prove crucial in determining what happens in the markets really in the near term. That's pretty much our update for financial markets. We hope that you do have a very, very productive week. Thank you very much.